Good evening, everyone. Time for another silver update. Now, this is the weekly chart of silver provided by netdania.com. You can click on the link below. Now, you can see that silver's forming into kind of a compression coil type of situation here. And this price that it's forming at, you have to remember that silver marks the financial crises and false flag events and all these things, that what happens in silver is directly related to the powers that be. And the reason why that is because the powers that be are the primary ones behind suppressing the price of silver. Now, this high was the Bear Stearns top, and this high was the capture of Osama bin Laden, the release of Barack Obama's birth certificate, and 7 simultaneous increases in the margin hike. This was the Boston bombing. So we know that silver is very key to all of the events that are going on. And I want to show you a video, an excellent video from Belange P about Hubbard's Peak, which is a concept in the oil market about peak oil, but he does a video here about peak gold and peak silver. So I want you to think about the idea that the reason why gold is valuable is because it's so high priced. And the reason why it's so high priced is because people value it. So I'm going to try to flesh this out further, because this is the circular reasoning that we see. This is the information that we get from FOFOA. This is the information that we get from central bankers. This is the information that's implied by Belange P. And I'm trying to prove to you here that this is just simply circular reasoning. So let's listen to a little bit of this video about Hubbard's Peak. And this is just finishing up about gold and then talking about silver, and I'll stop and comment.
But that really doesn't matter. All it means is that the main quality that makes gold an attractive store of value, namely its high stock-to-flow ratio, will persist into the future. I've covered the importance of a high stock-to-flow ratio in many other videos. Please go watch them if you want more details. But in brief, the importance of the high stock-to-flow is that it's evidence that the world hoards the item as a store of value, and that there will be no large supply shocks to disrupt the value of the above-ground stock.
Okay, so that's in essence the FOFOA argument. The reason why gold is priced so high is because it's priced so high. That's the essence of the argument. Now, you have to understand the way the minds of central bankers work to understand this argument. What he's saying is that because gold is priced so high that virtually all of the gold that's ever been mined is hoarded, there's such a large above ground supply of it that a supply shock can't affect the price that much. But the only reason why there's such a high above ground hoarded supply is because the price is so high. So this is simply circular reasoning. This is the loop that central bankers want you to get into, because they don't want you to think about why that's not the case with silver. Because we know for centuries that silver was the equivalent of gold as far as being money. But for some reason now they want to convince us that silver's different than gold, but it's not different than gold. It's just how badly they want to convince you that it is.
If the model is accurate, then we can predict that in 20 years, yearly production will be about 27% higher than it is now. The total above-ground stock will be about 43% higher than it is now, but the ratio of the production to the above-ground stock will actually diminish. It will go from 1.7% per year down to about 1.5% per year. This should make gold an even more reliable store of value. And so it's a good thing, even though gold production is probably not going to peak over the next couple of decades. Now let's take a look at silver and see what the analysis says to us. Again, we'll start off by fast forwarding past the preliminaries. Here's actual world silver production data for the past century plotted as a Hubbert linearization.
Okay, so let's start with where we get this data, because here's the Silver Institute, and I've already commented many times about the data, but very interesting here. Look at this. Each year, the Silver Institute works with, who is it? Thomson Reuters. Yes, that's right. The same people who were involved in the silver fix. So the same people who are giving you the data of what the price of silver should be are the people who are also telling you the data of how much silver is mined every year, how many net government sales there are every year, how much is used for coins and bars, how much is used for other things. Interestingly, we can see here from 2012 to 2013, we get a jump from 139 million ounces to 245 million ounces, a 100 million ounce jump. As people like Jason Hommel have pointed out before, traditionally these numbers were all the same, total supply, total demand, they were the exact same number, but now we have this interesting new surplus deficit. Now I've already covered how they retroactively have changed these reports. So keep that in mind. Remember Orwell. We're at war with Eurasia. We've always been at war with Eurasia until the next day, and that's no longer true. So keep that in mind. These are the people that we're dealing with. These are the people who actually change historical data.
There are two things that immediately leap from the page. The first is that the data is quite linear over the time period that represents more than half of the total historical production. And that fact should make this quite useful. The second thing to notice is that the line seems to be going in the wrong direction. It's positive and not negative in slope. And what's the consequence of this? Well, it means that the growth rate of silver production is not only exponential, but it's super exponential. The exponential rate of growth is actually increasing in magnitude and not decreasing. Suffice it to say that this cannot possibly persist forever, but if it persists for even the near term, then silver production can be expected to stay strong in the near future. Let's see what the plot of production as a function of time looks like. The model fit to the data describes its shape very well, and so the logistic differential equation holds. It shows the super exponential growth rate of silver production. If we extrapolate 20 years into the future, we can draw a few conclusions. First, the production rate of silver, if its current trajectory holds, will be 113% higher 20 years from now than it is today. Assuming that half of the production is used in industry and half of it is stored for wealth preservation, then 20 years from now we can expect the above-ground stock to be about 80% higher than it is today. Ultimately, what it means is that the growth rate in the above-ground stock will go from its current value of 2.7% per year to 3.2% per year. Again, I'm assuming a 50% consumption rate for industrial use, and so half of the newly mined silver won't be used to increase the above-ground stock.
Now, I want to remind you, if you remember in the 1970s, you had people like Paul Ehrlich and others who were predicting that there would be mass starvation in the world by the 1980s. Of course, these people were proven wrong. And what these scientists fail to understand is that markets are dynamic, that markets respond to prices, that markets respond to supply, that markets respond to demand, and things change. Now, I'm not even going to talk about whether or not I buy into the peak oil idea. Primarily, I don't, because I think I'm not convinced yet that oil is a non-renewable resource. But we know that gold and silver are non-renewable resources. The only difference there is between gold and silver is that gold is always recycled. And the reason why it's always recycled is because its price is so high. So Now, I wanted to have you think about this a little bit because we have statements about the mining of these metals based upon their price. And down in the comments, you'll find a debate about this. You'll find a debate about how silver is a byproduct of other metals. So I wanted to discuss that a little bit. Now, I don't have the citations, but you can look them up yourself. They're pretty much in agreement that for the most part, 75% of the silver that we get each year comes as a byproduct of base metals. Now, and also gold. So we want to keep these figures in mind here, that the silver mine production has gone from about 630, and again, these are Thomson Reuters numbers, GFMS. But anyway, the numbers we're given are 613 million ounces to last year 819 million. So about a 25% increase. Now, remember, keep in mind that 75% of the silver that we get from mine production comes as a byproduct. So remember the statement that I made earlier. The reason why people prefer gold over silver is because people prefer gold over silver. Because that's in essence what their argument is. Their argument is that the reason why the price of gold is so high is because the stocks of above ground gold are so high, and therefore the amount mined doesn't impact it each year. And the reason that that's the case is because the price of gold is so high. So the reason that gold is so high is because gold is so high. So what I'm proposing is that this is just a bunch of mind control, and that what people should be more interested in investing in is something that's more valuable, and that would obviously be silver, as Eric Sprott points out all the time. But let's look at some of these base metals. Now, I did the research on it. We know that copper, lead, and zinc and gold, those are going to be the big four metals where silver comes in as a byproduct. And so we know, since silver is 75% of the silver we get comes in as a byproduct, then we know there must be some kind of incredible demand for whatever else it is that gives us silver. So is that copper? Well, if we look at the action in copper, it's very interesting. We can see that the 5-year LME copper warehouse stock levels have gone from a record high to a record low within 1 year. So that's very interesting. That's one of the key metals that has to do with silver being a byproduct. The other one is zinc. And if we look at the 5-year zinc, we can see a fairly stable price. And then we can see the stocks hitting a record high, then dropping down. So kind of a neutral one with zinc as well. And then we want to take a look at lead. And on the 5-year, we can see that the warehouse levels have gone down, certainly, but they're not super low. And then when we look at the price, we can see, well, I lost that screen here, but the price has been fairly stable. There's 5-year lead spot. So what does this all mean? What does it mean that we continue to get more and more silver mined every year? Now, I'm not even going to talk about these phony net government sales and scrap and net hedging and all this, because this is just nonsense from Thomson Reuters. But the question is, if the amount of silver mined has gone from 613 million ounces a year in 2004, 10 years ago, to whatever they're going to come up with next, at least a 25% increase. Why? Why has that happened? So the analysis about peak oil, peak gold, it has no application whatsoever to silver. Because as Jeff Nielsen has pointed out many, many times, that the reason why there are no primary silver mines is not because it's just not something anyone wants to be in the business of anymore. It's just that the other metals that are in those mines are more valuable to mine. So silver becomes a byproduct simply because its price is so suppressed. So I have great respect for BlanchP and FOFOA as well, but still ultimately for me the argument comes down to this. The reason why the price of gold is so high is because the price of gold is so high. And we'll talk to you next time.